Testing, testing. Can you hear me okay? All right, I see we've got 3 people tuned in so far. Thank you for joining us. Give me just a couple of minutes while we wait for some other viewers to tune in, and then we'll begin the webinar. All right, I see we've got 7 people tuned in now. Thanks for your patience. We're just waiting until exactly noon to start. Waiting for a couple more viewers to tune in. right. Hello, everybody. Thank you for joining us for Blockmatic's latest webinar. My name is Cameron Carpenter. I'm a financial research associate here at Blockmatics. If you're not familiar with us, Blockmatics is a consulting and education company that produces interactive, in-depth training programs on blockchain technology, its use cases, and its implementations. Blockmatics grew out of market demand in 2014 for concise yet comprehensive professional educational content on blockchain and distributed computing systems. We offer formal courses on all aspects of blockchain, from a basic introduction to advanced programming, as well as industry-specific deep dives, in-house trainings, workshops, executive briefings, and consulting services. We will customize a program to meet your needs. Connect with us to learn more about blockchain and decentralization. Today, I'm going to talk about two industries within the financial sector that are highly inefficient, very expensive, and perhaps even downright predatory in certain cases. Then, I'm going to tell you how blockchain might be the solution to these pain points. I'll explain the problems with these industries in detail, highlighting the current state of affairs. Then, I will explain various blockchain-based alternatives and consider the benefits and deficiencies with each. The problematic industries that I'll be talking about today fall under the category of shadow banking. Shadow banking is a designation for financial services firms that offer typical banking services such as asset management, payment processing, or loans, but are not actually chartered banks. This designation includes services for the wealthy, such as private equity firms or hedge funds, as well as services for the poor. For the purposes of this webinar, we will be focusing on two services primarily aimed at impoverished populations: remittance payments and payday loans. Payday loans are a form of credit issued against one's future earnings. The barrier to entry for payday loans is significantly lower than that of other more traditional credit products, such as credit cards or home mortgages. Typically, good credit is not required, or necessarily even any credit. The borrower must prove that they have a valid bank account and are employed in receiving regular paychecks. The borrower then writes a post-dated check for the loan amount plus interest and fees to the lender to be cashed upon receipt of the paycheck. These are short-term loans with maturity dates anywhere from a couple of days to a month. Typically, the principal amount is $500 or less. When all fees and interest rates are taken into account, payday loans have an average APR of 400%. That's a staggering figure, but keep in mind that that's the annual interest rate. These loans are not meant to be held for a year. Typically, a $100 payday loan with a maturity date of 1 week from issuance could cost $30 on average. On even the highest interest credit cards, $30 in interest charges would only accrue after a year of carrying the balance. For those who pay back the loans according to the original terms, payday loans can serve as a last resort option that, while undoubtedly expensive, may be necessary to make ends meet. The real dangers of payday lending come in the case of those who are unable to repay in the allotted time frame. They are forced to take out more debt from the payday lender to cover their existing debt and the interest, trapping them in what is essentially a cycle of debt serfdom. Remittances, the other shadow banking service I'll be talking about today, are payments sent by economic migrants back to their home country. These transactions are notoriously complex, expensive, and slow. All of the moving parts necessary to make these transactions happen has turned remittance payments into a $430 billion industry that's funded off of hardworking immigrants trying to send money home to their family. For traditional remittance payments, one must either use an international bank wire transfer or a remittance payment processor. Just as in the broader financial services industry, the remittance payment processing industry is dominated by a few big names: Western Union, PayPal, MoneyGram, Ria, Transferwise, and World Remit. Western Union is by far the largest of these service providers, with 500,000 agents in over 200 countries with support for 130 different currencies. The company offers several ways to conduct transactions: in person, online, through their mobile app, or over the phone, with fees varying depending on payment method used and which medium you send the payment through. According to Western Union's fee estimator, sending $100 from New York to London via a 4 to 5 day bank-to-bank transfer would cost $2.99. 3% isn't bad, but what if you needed the money to go through instantly? That would cost you 5%. Still not terrible, but what if the person you're sending the money to doesn't have a bank account and needs to receive the funds in cash? That will cost you 6% for a 4 to 5 day business transfer and a whopping 12% for an instant transfer. Now, what if you were sending the money to someone in Zimbabwe as opposed to London? The terms are far worse. That would incur a fee of 8.5% for a bank-to-bank transfer and 12% for an instant transfer. When sending money to developing countries, there's no cheap option the way there is when you're sending money to Western Europe. These figures don't even include the highly unfavorable foreign exchange rates that Western Union charges their customers. For a migrant worker sending their hard-earned money back to their family, these fees could make it impossible to make ends meet. MoneyGram's rates aren't much of an improvement. According to their fee estimator, a $100 transfer to Zimbabwe from New York would cost between $9 and $11, depending on the payment method used. RIA doesn't serve Zimbabwe, but their rates for bank-to-bank transfers are more reasonable, 3% to send money to Ghana, according to their fee estimate. If you need to send the money immediately, however, and you would need to use a credit or debit card, which would cost you between 8% and 11%. It is important to note here that high fee isn't entirely the remittance payment processor. Part of that is the credit card company's fee as well. Transferwise is significantly better, but it does not have the wide reach that others like Western Union do. Transferwise takes a 3.8% fee of a bank transfer from the United States to Kenya. However, Transferwise claims not to mark up the foreign exchange rates the way Western Union does. However, Transferwise does not have the capability to pay recipients in cash, excluding the unbanked from their services. Another option is PayPal. PayPal's Zoom service charges 5% for payments from a US bank account to a Nigerian bank account, and 10% for payments from a credit or debit card. Zoom also makes money off the unfavorable exchange rates they charge their customers. Now, what if we skipped the remittance processors and dealt directly with international bank wires? That may be the worst option of all. International bank wires charge flat rates, regardless of the size of the transaction, which is good if you're sending large amounts, but can be devastating if you're sending small sums. Chase Bank charges $40 to send an international wire transfer, and then another $15 to receive one. That means if you sent money from one Chase account to another on the other side of the world, it would cost you a grand total of $55 in fees. Again, that doesn't include the highly unfavorable exchange rates, and again, what about the unbanked? If there ever was an industry begging for disruption, it would be remittances. While in certain limited circumstances, such as a bank-to-bank transfer to London, using Western Union might only incur a relatively small fee. However, remittances to countries only serviced by Western Union and MoneyGram, such as certain frontier markets in Africa and Asia, or remittance payments from one unbanked individual to another that therefore must go through Western Union or MoneyGram because they have the capability to deal with cash, can be prohibitively costly. One could make the argument that remittance payment processors are engaged in the ultimate rent-seeking enterprise, draining money from those who are most in need in the name of profit. On a macroeconomic level, the exorbitant fees have the effect of trapping segments of society in poverty, essentially establishing a ceiling on upward mobility. Also, in the case of remittance payments, wealth is siphoned from the developing world by first world corporations. This only exacerbates global inequality. The counterargument would be that processing remittances is hard work that requires compensation. The solution then appears to require an examination of why these services are so expensive. In the case of remittances, the expensive nature of the transaction comes from several factors. One is the heavy regulatory and compliance burden placed on money transmitter services like Western Union. Another is the fact that the current remittance payment processing companies basically make up an oligopoly, which decreases market competition. It also comes from the fact that a lot of these services are typically cash-based, which requires a substantial amount of infrastructure in place, including brick-and-mortar locations and trained agents. Some payments to developing areas must also be routed through multiple different financial institutions, each one taking their own cut. Given the potential for a service like Western Union to be used for illicit finance and money laundering, there are extensive regulatory burdens that these firms must comply with. Western Union has to collect Know Your Customer information on all of their customers, including information on the sender and the receiver, information on the source of the funds, and information on how the funds will be used by the recipient. Then, Western Union must monitor the progress of the funds, ensure that the beneficiary receives the funds, and ensure that neither the beneficiary nor the originator plans to use the funds for illicit finance or money laundering. Western Union also has to keep all of the transaction records to maintain a bird's eye view of cash flow throughout their system. This is no small feat. In 2012, a total of $80 billion divvied up into hundreds of millions of individual transactions moved through Western Union alone. Fulfilling Know Your Customer anti-money laundering requirements for $80 billion across hundreds of millions of transactions is incredibly laborious work. And if even one criminal transaction manages to sneak its way through Western Union's defenses, the company could be hit with substantial fines by regulators, which will ultimately be passed on to their customers. Combine all that with the tendency among oligopolistic businesses not to cut costs to better serve customers, and you've got a recipe for an extremely expensive service. Before we go on to the potential solutions posed by blockchain technology, I wanted to ask if anyone has any questions. Please feel free to pop them in the chat, and I'll address certain questions now and then some at the end of the webinar. I'd also like to take a moment to tell you a little bit more about what we offer here at Blockmatics. In addition to our free webinars like this one, we offer in-person courses. Check out our upcoming events on our website, blockmatics.tech, and follow us on social media and sign up for our email newsletter. Additionally, we can create custom training and workshops to meet your specific team needs. Just send us an email at info@blockmatics.tech. Our lead instructor, Solomon Lederer, received his doctorate in distributed and ad hoc computer sensor networks from Stony Brook University. He came up with novel ways for networks to self-organize and went on to apply his research for the US Air Force in developing new wireless communication technology. He's been teaching about blockchain and Ethereum for 3 years now and recently co-authored Blockchain, a practical guide to developing business, law, and technology solutions. Connect with us through our website, blockmatics.tech, or email us at info@blockmatics.tech to learn more about the services we offer. Okay, let me check and see if we have any questions. Feel free to add your questions as I go along, and I can address them at the end of the webinar. We'll have a Q&A session. Okay. Now that the problem with remittance payments is clear, let's look at some of the potential solutions that utilize blockchain technology. The most obvious, and in certain respects, the most inclusive blockchain use case for solving the remittance problem is cryptocurrency. Indeed, spending enough time looking at remittance payment options will make anyone understand the value of a borderless, permissionless, peer-to-peer decentralized currency that settles with finality in less than 24 hours and is capable of handling $100 million transfers with as little as $1 in fees. Cryptocurrency is, notably, the only solution at the moment that addresses the problem of the unbanked. An estimated 2 billion people worldwide do not have access to banking services, making it impossible for them to build credit or savings. The main problem with cryptocurrencies is one's limited ability to use them for day-to-day transactions. However, this is rapidly changing. Countries like Venezuela are seeing interest in cryptocurrencies rise as the value of their national currency falls. The fact of the matter is, in certain circumstances, cryptocurrencies are a preferable form of money to local currency, or even to dollars or euros, given their unprecedented ability to move around the globe at high speeds. Of course, cryptocurrency is not a perfect solution. In many places, it is impossible to live off cryptocurrency, requiring the holder to liquidate to a local fiat currency to pay their expenses. This requires either having access to an online crypto to fiat exchange, which requires a bank account and thus invalidates the original purpose of helping the unbanked, or one must have access to a peer-to-peer means of exchanging cryptocurrency for cash, something like localbitcoins.com. Cryptocurrencies do certainly express high volatility levels, which is not a desired trait in a currency. However, at least with cryptocurrencies, there can be an upside to the volatility level. With the Venezuelan bolivar, for instance, there is only one direction that the value of that currency is currently moving. Cryptocurrencies also require access to technology, at least a phone capable of sending SMS messages. For the extremely impoverished, this may be an insurmountable hurdle. However, with manufacturing capabilities increasing rapidly, the cost of basic or even smart cell phones has dropped dramatically. In India, for example, one can buy a basic smartphone for the equivalent of $3.60. That means for an Indian migrant worker in the United States sending money back home, the cost of buying your family that smartphone would most likely be less than the single Western Union fee. In the developed world, cryptocurrency is still mostly either a novelty or an investment. It's not cheaper or easier to use for the consumer, and it's certainly not as secure as dollars or euros. However, for the developing world, cryptocurrency is a revolutionary concept that has the potential to bring vast swaths of previously excluded individuals into the global financial system at a fraction of the costs imposed by the legacy systems. To keep cryptocurrency competitive against Western Union and the others, transaction fees must be kept as low as possible. During the Bitcoin price rally last December, transaction fees rose to $55 due to network congestion. That's a flat fee, which means that sending $100 through Bitcoin would have cost the same as sending it through a Chase Bank international wire transfer. Bitcoin's transaction fee has since returned to highly competitive levels. However, the potential for massive fees encourages the search for a proper scaling solution. Of course, one could always use a different cryptocurrency, such as Litecoin or Bitcoin Cash, both of which are faster and cheaper than Bitcoin on average. However, these cryptocurrencies are not as widely traded, making it less likely that both parties will have access to an easy means of exchanging them for fiat cash. Another potential scaling solution may lie in the Lightning Network, which is a proposed off-chain scaling solution for Bitcoin transactions between relatively trusted parties. Cryptocurrencies are the best remittance options for very specific situations. If someone working in the United States and sending money home to Venezuela, for instance, assuming both parties have access to a means to convert their crypto into fiat, for them, crypto is the cheapest, fastest, and most open means to do so. However, cryptocurrency is not a general solution to the problem. In certain cases, while it does appear to be the best solution, for some it is simply unfeasible. Whether that's due to distrust of the new technology, or lack of technical expertise or access to technology, or the inability to properly exchange fiat for cash consistently, we have to acknowledge that crypto is not a proper solution for everyone, or necessarily even most people trying to send remittance payments. The answer may not lie in directly carrying out remittance payments in cryptocurrency, but in enlisting these cryptocurrencies to streamline transactions. Several startups are promising to use cryptocurrency networks to process bank-to-bank remittance payments quickly and cheaply without requiring the customer to interact with the digital currencies directly. BitPesa is one such company which provides digital money transfer services to frontier markets in Africa. Specifically, the company operates in Ghana, Kenya, Nigeria, Senegal, Tanzania, Uganda, and the Democratic Republic of Congo. BitPesa offers 3 services: BFX for foreign exchange transfers into and out of the listed countries, Paysi, a fiat to crypto exchange for the above markets, and Transfer Zero, the company's business-to-business white label remittance service. BitPesa processes remittance payments by converting the initial amount in, say, US dollars into Bitcoin, then exchanging that Bitcoin for the destination currency. This has the effect of circumventing the foreign exchange markets and avoiding the highly unfavorable rates that Western Union and others charge their customers. This also allows funds to be transferred in as little as 1 to 24 hours. BitPesa charges a fee of 1 to 3% of the transaction, significantly better than the other options like Western Union. Another business worth mentioning, even though it's not strictly speaking a remittance service, is Ripple. Ripple created a blockchain network with its own token, XRP, and processes business-to-business and bank-to-bank transfers using that token in the same manner that BitPesa uses Bitcoin. However, Ripple's XRP is much cheaper and faster than Bitcoin. Transactions on the XRP network can be confirmed within seconds and on average cost less than 1 cent. This makes XRP an ideal candidate for performing back-end remittance transactions. XRP has drawn criticism from cryptocurrency purists who consider it centralized. Indeed, the concentration of power over the network in the hands of Ripple, the company, somewhat detracts from the decentralizing mission of blockchain. However, it does make it undeniably more efficient. Ripple markets itself to banks and payment processors as a much faster and cheaper way of conducting international transactions. Ripple offers business-to-business and bank-to-bank services. It has no business-to-consumer services, meaning the sender of the remittance payment likely wouldn't even be aware that their money was being transferred through Ripple, as all that would be handled on the back end. MoneyGram has announced that it will be testing Ripple's xRapid service, which utilizes the XRP blockchain and token for cross-border payments. BitSpark offers a product similar to that of Ripple and BitPesa's white label service. The company processes payments for other remittance services by converting the origin currency into cryptocurrency and then converting that cryptocurrency into the destination currency. That's essentially the business model of all of these startups. One notable feature of BitSpark is the ability to receive funds sent in cash, which most other blockchain remittance services don't allow for. BitSpark doesn't have a set transaction fee. Instead, the fee is determined by the remittance business using their platform. BitSpark claims that transaction times range from a few hours to a single business day. Blockchain technology, specifically the digital currencies that operate on blockchain networks, create a workaround to avoid traditional, expensive remittance payment services. Whether one takes a do-it-yourself approach and sends cryptocurrencies directly, or utilizes a service like the startups mentioned above that use a digital currency on the back end to expedite the transaction, blockchain technology has provided the infrastructure necessary to reinvent an inefficient and expensive industry. Are there any questions at the moment? All right, I'll continue. Feel free to post questions as I go. We can address them in the Q&A at the end of the webinar. Now that we've discussed the implications of blockchain on remittances, Let's move on to its implications on payday lending. Currently, there are several blockchain startups aiming at providing loans to those without credit profiles. Several platforms have emerged that allow you to borrow against your digital asset holdings. One such platform is Salt Lending. Here's how the business model works. Clients secure cash loans by offering their cryptocurrency, such as Bitcoin or Ether, as collateral. If the borrower is unable to repay, Salt keeps the cryptocurrency as payment. This allows Salt to offer loans to individuals with bad or no credit without having to charge exorbitant fees. While these platforms might be useful for individuals with significant crypto holdings and no other assets to borrow against, they don't have much to offer the payday lending clientele, as cryptocurrency usage among that income demographic is sparse. Also, Salt charges between 12 to 22% interest annually on their loans. That's about the same rate as a reasonably priced credit card. However, considering that these are actually secured loans, that interest rate isn't much of a bargain. Home equity lines of credit, which are secured by the value of a borrower's property, typically carry an interest rate of 5 to 6%. Ripio, formerly BitPagos, is a Latin American blockchain startup that aims to provide credit services to traditionally excluded demographics. Ripio is a peer-to-peer lending service that allows several lenders to pool their risk with a third party referred to as a cosigner. This cosigner takes a fee from all of the lenders in exchange. If a borrower defaults, the cosigner reimburses the originator of the bad loan out of the fees they've received from cosigning with the other transactions. Essentially, it's an insurance contract. Ripio claims that such a system effectively ameliorates the risk of peer-to-peer lending and thus allows them to get away with not charging exorbitant interest rates. Only time will tell if this business model is sustainable in the long term. One startup aimed at directly affecting the payday lending industry is OWO, a company which is planning its debut later this year. OWO, founded by a Nigerian entrepreneur, hopes to use smart contracts to ensure that payday loans are repaid on time by automatically debiting a borrower's bank account at the time a paycheck is received. The emerging company hopes that utilizing blockchain-enabled smart contracts will allow lenders to charge lower rates by providing a reasonable guarantee of repayment. As with any emerging technology, we have yet to see blockchain's full tangible effects, and predictions about the future of any emerging technology have a tendency to age poorly. What we have in blockchain is an abundance of potential. Potential to re-engineer outdated and expensive industries such as remittances and payday lending by cutting the costs, both financial, chronological, and labor-wise, of international funds transfers and lending to borrowers without credit. Hopefully, the integration of blockchain technology would lead to an industry-wide reform of some of the darkest parts of the shadow banking sector and make the system more equitable overall. What remains to be seen is what effects this raw potential will have at the micro and macroeconomic level. Perhaps blockchain technology will create a rapidly more efficient and fair lending and global payment system for the underbanked. Or perhaps this new technology will create a whole new set of gatekeepers who will utilize it to maximize their profits without passing any savings along to the customers. Again, only time will tell. All right, so we've got a question here. Yes, the high volatility is a risk. However, the businesses only hold the cryptocurrency for a minimal amount of time, usually 1 to 24 hours. So yes, it does introduce a risk. Part of that risk is covered by say, if we're talking about BitPesa, the 3% fee that BitPesa takes is also to cover a portion of that risk. But generally, since the crypto is only being used as a medium of exchange, not as a storage of value, the risk is not the same as, say, a business that accepts cryptocurrency as payments and then held that cryptocurrency rather than exchanging it into a fiat currency. Does that make sense? Yes, yes. Also, it is a problem for individuals who choose to conduct remittance payments in cryptocurrency. Again, you could, assuming you had proper access to exchanges on both sides of the transaction, if you used cryptocurrency solely as a medium of exchange, rather than as storage of value, rather than holding the coins themselves, while you do expose yourself to some risk, it's essentially a trade-off. Your fees for sending a remittance payment in the form of cryptocurrency might only be $1 compared to the 10%, which on a $500 transaction would be $50 that Western Union would charge you. However, you take on the additional risk that you're dealing with a volatile asset and that the price is subject to change. Cryptocurrency is not a perfect solution by any means, but it offers the seedlings of the potential for real change in this industry. Exactly right. That's a big problem. That's why cryptocurrency is only really a solution for the unbanked if they can exchange it for cash in person from a peer-to-peer cryptocurrency deal. If you're familiar with the website localbitcoins.com, it's essentially a site that connects buyers. It's a peer-to-peer market. You can connect with someone there. If you're looking to buy Bitcoin or sell Bitcoin, you can connect with someone who's looking to do the opposite, and you can either meet with them and conduct the transaction in person, or you can conduct it electronically. So it is a very big problem, and it does take away from the potential of liberating the unbanked. That's another reason why it's really important to focus on the companies using cryptocurrency networks to process these transactions. If, for instance, the MoneyGram deal with Ripple, their test pilot works out, and they decide to actually employ XRP to carry out international transactions, and they do pass the savings along to their customers, that would be a much preferable option, I believe, for someone looking to send remittances than buying cryptocurrency, sending it, and having to have the receiver on the other end exchange it back out into their fiat currency. Because yes, it is very complicated, and there's plenty of room for exchange rate slippage and technological difficulties and all kinds of risks that are opened up, which is why if you have the cryptocurrency working to process the transactions on the back end and an established company like MoneyGram actually dealing with the front end customers, it would be the process would be much more smooth. All right, does anyone have any other questions? All right, well, thank you very much, everyone, for joining us for this webinar. We hope you found it informative and engaging, and it's given you an idea of how blockchain technology solutions can solve real-world problems. If this webinar has piqued your interest and you'd like to learn more about blockchain, consider enrolling in one of Blockmatic's courses. Whether you're new to blockchain or you'd like to expand your existing knowledge, we have offerings for all skill levels and professions. If you'd like to talk to us about in-house training for your team, send an email to info@blockmatics.tech and we will follow up. Thanks for joining the webinar, and make sure to follow us on social media so you don't miss the next one.